This class, Understanding the Mortgage Industry, counts as a 4-hour elective credit class with the North Carolina Real Estate Commission. We have 3 goals for you today. First is your credit with the North Carolina Real Estate Commission. Second is to grow your knowledge so that you can make better mortgage-related decisions, not only for yourself personally, but professionally as you guide your clients. And lastly, a better understanding of the system and how it's currently working today. So those are our 3 objectives for the day. Our agenda. We're going to talk about the mortgage industry as a whole. We're going to talk about everything from the time a consumer decides they want to buy a residential real estate property all the way through the very end to the time when they either sell it, they pay off their mortgage in full, or they do some kind of workout deal with the mortgage company and that mortgage loan comes to the end. So we're going to talk about a lot of different things today. We're going to focus in and talk about the core revenue generating processes in the first part of the class. So who are the entities involved with loan origination of your everyday vanilla residential real estate transaction? What is the process that a consumer might go through when they come in contact with that entity? And how are they driving revenue from that process? So we're going to talk about in the first part of the class the core revenue generating processes of the entities involved with loan origination. Then we're going to talk about now that the loan has closed. Who has an interest in this loan? And how might they experience a loss associated with that? So we're going to talk about what drives losses, because I believe that if you understand who's involved with this transaction and what drives revenue for them and what drives losses for them, that you'll be able to speak to them in a more intelligent way, and that'll be more successful in getting your transactions to close. So we're going to talk about expense generating processes. We're going to talk about how to assess the status of a mortgage. We're going to talk about a few causes for default, and we're going to close out, and I mean just with a very few minutes, briefly touching on some of the workout options that are available to homeowners. So, like a buyer, when they decided to buy a house, needed a few things, one of which was good credit, money for a down payment, positive cash flow. So they needed to have a few criteria or meet a few basic criteria in order to buy that house. They had to be ready, willing, and able to do some things like produce documents for their mortgage company and talk with them. Well, just like there were products available to that buyer, fixed rate, adjustable rate, interest only, pick a pay, there are products available to a homeowner who has an involuntary hardship, death, divorce, illness, unemployment. So something bad happened to them, no fault of their own. There are some products available to them, short sales, loan mods, deed and liens, and over the last 8 years, you've probably heard those words thrown around on the news, or you've seen them in the paper. So we're just going to briefly, I mean very briefly, just take a few minutes and talk about what each one of those options were, so that if someone were to ask you about that or it were to come up, you just have a little basic idea of what that is. So we're going to talk about everything from the time the consumer decides to buy all the way through the end of the mortgage. They paid it in full, they sold it, or they did some kind of workout deal with the mortgage company. So we're going to talk about a whole bunch of different things today.